General Motors Q2 2026 just dropped, and it is a massive beat on the bottom line. I mean, the top line is honestly a total snooze revenue hit $48.0 billion, so that's up just 1.9% year over year.
Yeah, barely moving the needle at all.
Right. But then you look at the EPS, the diluted adjusted earnings per share, and it came in at a massive 3.57.
Which is a huge jump.
It's a 41.3% surge compared to last year. Oh. And the beat was so heavy that management is officially raising their full-year EBIT adjusted guidance for the second time this year, actually.
Wow, twice in 6 months.
Yeah. They're now projecting between $14.0 billion and $16.0 billion, and they bumped up automotive free cash flow guidance, too, to a range of $9.5 to $11.5 billion. Now, since pre-market price action isn't available in the release for us to see how the street is digesting this yet, we're looking straight at the capital return headline. The board declared an 18-cent quarterly cash dividend.
Okay, let's unpack this, because if you are a retail investor looking at these numbers, there's a glaring contradiction staring you right in the face. There really is. I mean, the tension between that stagnant top line and the explosive bottom line is just immediate. You know, you cannot organically grow earnings by 40% when your sales are virtually flat without pulling some serious operational levers behind the scenes.
Right, because it makes zero sense on the surface. Like, revenue only inched up 1.9%. So we are definitely not seeing a sudden, massive influx of consumers rushing to dealerships to buy more cars.
Exactly. The volume just isn't there.
Yet somehow, adjusted earnings skyrocketed, and they're hiking guidance again. So the mission for our deep dive today is to figure out the exact mechanics of how GM is squeezing that much juice out of a flat top line. And more importantly, we need to look under the hood at the massive hidden charges in the GAAP numbers to see what they reveal about the reality of their EV pivot.
Which is, let's just say, a lot messier than that headline EPS suggests.
Oh, absolutely.
Because management teams, they always want you to focus on the consolidated adjusted view, right? Because it smooths out the turbulence. But to understand the actual engine driving that 41% EPS surge, we have to bypass the overall corporate narrative and look directly at segment performance.
Specifically North America.
Yes. The absolute powerhouse of General Motors right now, GMNA.
So let's lay out the GMNA figures for everyone, because they are basically carrying the entire company on their back at this point. EBIT adjusted for North America hit $3.45 billion.
That's a massive number.
It is. That's up 42.7% year over year. And the margins, they expanded by 2.5 percentage points to hit 8.6%.
What's fascinating here is, well, generating a 2.5 percentage point margin expansion for a legacy automaker in a single year, that is a massive structural shift.
Yeah, it's not something you just stumble into.
No, not at all. It requires a level of operational discipline that is, quite frankly, very difficult to execute at this kind of scale.
I mean, I hear the discipline argument, sure, but to put this into perspective for you listening, imagine a massive factory, right? Mm-hmm. And this factory hasn't expanded its assembly line. It hasn't hired more people.
Right.
And it certainly hasn't shipped more product out the back doors. In fact, if you look at the wholesale vehicle sales in North America, they were completely flat.
Like, exactly.
Literally.
Yeah.
We're talking 848,000 units in Q2 of this year, compared to 849,000 units in Q2 of last year. So the factory shipped 1,000 fewer units, yet somehow almost doubled its profit output.
Yeah, I know it looks like an accounting trick, but it is actually a masterclass in product mix and pricing architecture. I mean, they aren't selling more vehicles, they are just heavily prioritizing the production of their highest margin vehicles.
You mean the trucks?
Exactly.
Yeah.
The fully loaded heavy-duty trucks and those large SUVs like the Tahoe and Suburban. You have to remember, the research and development costs for those internal combustion engine chassis, they were paid off a decade ago.
Oh, that's a really good point.
So when GM decides to bump the MSRP on a Silverado by a few $1,000s, or, prioritize a trim package with premium leather and upgraded infotainment, almost all of that price increase flows directly to the bottom line.
But I have to push back a bit on how sustainable that actually is. Because you can't just cost cut and price hike your way to infinity.
Fair point.
Right? Like, if you are just squeezing more profit out of the exact same number of vehicles, you're relying entirely on pricing power. You are essentially betting that the American consumer will just keep absorbing higher monthly payments for the exact same trucks.
Yeah, betting on the consumer's wallet to just keep opening.
Exactly. And as an investor, you really have to ask how long GM can rely on that specific playbook to drive margin expansion without actual fundamental volume growth. At some point, you hit a ceiling.
Well, I mean, management would argue they are nowhere near that ceiling yet. And the liquidity they are generating right now gives them a massive buffer.
I guess that's true.
While you're right to question the long-term elasticity of consumer pricing, for now, the mechanics of what they're doing are flawlessly executing the primary goal of any mature business, which is capital generation. Just look at the adjusted automotive free cash flow.
Oh, man.
It surged 78% year over year to $5.03 billion just for this quarter.
Which is just an absurd amount of cash to generate in 90 days.
Right. And for you, as a retail investor, that adjusted free cash flow number is arguably the most vital metric on the entire earnings release.
More than the EPS, you think?
I do, because it is the ultimate measure of GM's current self-funding capability. It strips away all the paper gains and the depreciation, and it tells you exactly how much hard cash is left over after they've paid for the factories, the steel, the labor, and, the essential capital expenditures.
Right. They're sitting on over $5 billion of fresh cash.
Exactly.
Which totally explains why they have the confidence to declare that 18-cent dividend and aggressively hike their full-year guidance. Like, they have the actual cash on hand to back it up.
Yeah, they're proving that their core internal combustion engine business in North America is just a highly optimized cash machine. But, and this is a big but, that cash machine is operating in a vacuum on the adjusted ledger.
Okay, here's where it gets really interesting. Because if this cash machine is working so incredibly well and, adjusted EPS is up 40%, why did the unadjusted net income, the actual GAAP number, drop by a massive 31.1% down to $1.3 billion?
Yeah, that divergence between GAAP, generally accepted accounting principles, and non-GAAP, or adjusted earnings, is basically the classic battlefield of corporate reporting.
Oh, absolutely.
GAAP is the raw reality of the business, warts and all. Non-GAAP is management essentially saying, hey, if you ignore these one-time, unusual, and highly painful expenses, our core business is actually doing great.
So we had to pull back the curtain on those quote-unquote unusual expenses. Because when you look at the reconciliation tables in this report, you see a total of $2.45 billion in adjustments for this quarter alone.
That's a staggering amount to just adjust away.
Right. They essentially wiped away $2.5 billion of expenses to arrive at that rosy 3.57 adjusted EPS number.
Yeah.
And the lion's share of that. It's a massive $2.279 billion charge for what they're calling EV strategic realignment.
And just for context here, a year ago, that exact same EV strategic realignment charge was only $330 million.
Wait, so it is multiplied nearly 7 times over.
Yep.
What does EV strategic realignment actually mean mechanically? Because you don't just lose $2 billion in the couch cushions. That is a massive capital bonfire.
It really is. When management uses a phrase like EV strategic realignment to the tune of $2 billion, they're talking about a fundamental, incredibly expensive shift in their physical manufacturing footprint.
Okay, so it's not just like software updates.
No, this isn't tweaking a software algorithm or slightly delaying a vehicle launch. This means taking physical assets, stamping machines, robotics, assembly lines that were built for a specific battery form factor or vehicle architecture and literally writing them down to zero because that strategy didn't work.
Wow, so just scrapping the metal.
Yeah, it means buying out supplier contracts for parts you no longer need and heavily restructuring their battery joint ventures, specifically the Ultium Cells project.
So it is the brutal cost of realizing your initial strategy was either, too early, too aggressive, or just completely wrong for current market demand.
Pretty much. They are having to physically tear down and pivot a massive industrial supply chain in real time.
That sounds incredibly painful.
It is. And if we connect this to the bigger picture, this earnings report reveals the profound duality of General Motors right now. On one hand, you have the internal combustion engine trucks in North America. They are the highly profitable cash cows with decades of refined manufacturing efficiency.
Right, the 8.6% margin guys.
Exactly. And on the other hand, you have the EV division, which is essentially acting as a multi-billion-dollar startup operating inside a legacy corporation, and it's just burning through capital trying to figure out product market fit.
And the cash cow is entirely subsidizing the startup.
Yes. Management is using the massive cash flow from those gas-powered trucks to aggressively swallow the painful costs of restructuring their electric future right now.
Wow, okay.
By taking these massive GAAP charges today, they are attempting to clear the decks. They take the hit on the unadjusted numbers now to protect that long-term 14 to 16 billion EBIT adjusted guidance they keep raising.
It's almost like paying off a massive, unexpected credit card bill with your annual bonus just so your monthly budget looks clean moving forward.
That's a great analogy.
But that strategy only works if the bonus keeps coming in, right? Which means GM requires absolute stability everywhere else in the world to fund this EV pivot. But when we look overseas, stability is like the last thing they have.
Yeah, unfortunately. Historically, GM had a powerful, diversified global footprint that really insulated them from regional downturns. But the story in this report paints a very different picture of their international resilience.
Yeah, the numbers for GM International or GMI, they are frankly pretty grim compared to that North American fortress we were just talking about.
Very grim.
EBIT adjusted slipped 6.6% to $190 million. And nestled in those adjustments we just went over is a specific $177 million charge for China restructuring actions.
Which is corporate phrasing for the Chinese market fundamentally breaking away from them?
Yeah, the volume drop is severe. Look at this. In Q2 of 2025, they sold 447,000 vehicles in China this quarter, only 357,000.
Ouch.
That is a drop of 90,000 units in a single quarter, and their market share in China has now cratered to 6.6%.
We really have to unpack the mechanics of the Asian market for GM here, because for a long time, China was their guaranteed volume driver.
It was huge for them.
Right. And to operate in China, foreign automakers had to form joint ventures with local companies. For GM, these were SGMS and SGMW. For decades, the dynamic was super simple. GM brought the advanced internal combustion engine technology and the manufacturing know-how, and the local Chinese partners provided the labor and the market access.
And everyone made money.
Oh, these JVs printed money. They allowed GM to scale globally in a way that protected them from minor dips in the U.S. market.
But that technology transfer dynamic has completely flipped, hasn't it?
Entirely. The domestic Chinese EV manufacturers, companies like BYD, have aggressively moved down market and up market, capturing the consumer with highly integrated, localized technology.
They just leaped right over the gas engine phase.
They did. And more importantly, they own their entire battery supply chain, which allows them to offer price points that legacy Western automakers simply cannot match. China is no longer an emerging market where Western brands carry an automatic premium just for being Western.
Right. The local partners don't need GM's engine tech anymore because the market has moved to EVs.
Exactly.
So that $177 million restructuring charge is just GM acknowledging that their physical footprint in China factories built for a bygone era of dominance is way too large for their new, significantly smaller slice of the pie.
Yeah, they are actively having to shutter capacity and downsize their presence in what used to be their most important growth market.
Okay, so if GM is shrinking in China and burning billions on EVs globally, they absolutely need U.S. consumers to keep buying high-margin trucks to fund the entire operation.
They're their only lifeline.
But when you look at who is actually buying these vehicles right now, the foundation looks incredibly shaky.
Yeah, top-line volume is one thing, but the composition of those sales, like who is actually signing the purchase order, that tells you everything about the underlying health of the consumer and the quality of their earnings.
So let's look at those volume numbers because they are hiding some serious red flags.
Yeah.
We already established that worldwide market share dropped to 6.4%. But even in the U.S., their supposed fortress, total volume dropped from 747,000 down to 715,000 units.
Right.
The critical data point here, though, is fleet sales.
Yeah, and this is where you have to bypass the press release entirely and read the fine print in the supplemental financial materials to find the real story.
Absolutely. Fleet sales, meaning sales to rental car companies, local governments, corporate fleets, jumped to 22.3% of total vehicle sales. Just a year ago, that was sitting at 17.8%.
That is a massive jump in fleet dependency.
It is.
And this raises an important question regarding the absolute quality of their earnings. The report explicitly warns that fleet transactions, particularly daily rentals to companies like Enterprise or Hertz, are generally less profitable than retail sales to end customers.
The mechanism behind why fleet sales are lower quality is actually fascinating. When you go to a dealership and buy a Chevy Silverado, you are negotiating on one vehicle. You're probably adding higher trim packages, the leather seats, the upgraded infotainment, all that. That is a high-margin retail sale.
Yeah, you're customizing it. But when a rental car company buys vehicles, they are buying thousands of base model units at once, and they are demanding steep volume discounts just to take the inventory off GM's hands.
So it moves the metal off the factory lot, which keeps the factories running and revenue flowing, but it dilutes the overall profit margin per vehicle. But there is a secondary mechanism here that is even more damaging long-term, isn't there?
Yes, the residual value trap.
Ah, right.
Think about it. When you dump thousands of identical base model cars onto rental lots, those rental companies drive them hard for a year or two and then dump them at wholesale auctions. That suddenly floods the used car market with cheap, identical used Silverados or Malibus.
And when the used car market is flooded with cheap Silverados, the resale value of that specific model just tanks.
Exactly, which hurts the brand and makes everyday consumers less likely to buy it new. If you know your new truck is going to lose half its value in a year because Hertz is dumping thousands of them at auction, you hesitate.
Makes total sense.
Automakers will historically lean on their fleet relationships to pad their delivery numbers when retail demand softens, keeping the top-line revenue from crashing. But it is a lower quality revenue stream that eventually cannibalizes future retail sales.
So what does this all mean for you as an investor tracking this company? It highlights a significant vulnerability. If high-margin retail demand from the everyday American consumer is softening, and GM is padding its delivery numbers by pushing lower-margin vehicles onto rental lots, that 8.6% North American profit margin we were marveling at earlier might be sitting at its absolute peak right now.
It's a very real possibility, and if you want a leading indicator on consumer weakness, you just look directly at GM Financial, their in-house lending arm.
Oh man, yeah. EBIT adjusted for GM Financial dropped 14% year over year to $605 million.
GM Financial isn't just a lender, it is basically the thermometer for the American wallet. When interest rates rise, the monthly payment on an $80,000 Silverado becomes equivalent to a mortgage.
Seriously.
When we see a 14% drop in earnings before taxes in the financing division, while vehicle prices are supposedly holding steady, it points directly to consumer credit tightening.
It means buyers are either walking away from the dealership because they can't get approved, or GM is having to eat the cost of subsidizing cheaper subprime loans just to get those trucks off the lot.
Yeah. It also connects back to those residual values we just talked about. A huge portion of GM Financial's business is leasing.
Oh, of course.
If the used car value of a vehicle drops because of those fleet sales, the vehicle is worth less when the consumer turns it in at the end of the lease. GM Financial takes the financial hit on that depreciation. It is this cascading effect where lower retail demand forces fleet sales, which lowers used car values, which ultimately eats into the financing arm's profits.
Wow, it is the ultimate squeeze. The cost of borrowing is higher, making the monthly payment harder to stomach, forcing GM to rely on levers that actively degrade their future pricing power.
Yep.
Which brings us back to the core tension of this entire report.
Right.
GM's second quarter is a story of incredible, almost superhuman North American pricing power and cost discipline. They are squeezing every single drop of profit out of the traditional trucks they sell.
But that operational triumph in the short term is actively masking serious long-term structural issues. You've got global market share erosion, a retreating footprint in China where they were once dominant, and a massively expensive multi-billion-dollar EV course correction that is actively burning cash.
Management is clearly confident, though. I mean, you don't raise full-year guidance twice in 6 months and hike the dividend unless you believe in your internal cash flow projections.
True.
But the deeper we dig into the numbers, the more obvious it becomes that they are pulling some incredibly heavy short-term levers like fleet sales and non-GAAP accounting adjustments just to get there.
They are executing their internal playbook perfectly right now, protecting the balance sheet while they restructure. But the margin for error is shrinking rapidly. They're balancing a massive transition entirely on the shoulders of the American truck buyer.
Which leaves you with a final, forward-looking question to mull over as you digest this report, one that goes beyond just consumer demand. We know the EV division is burning cash and the China footprint is shrinking, making GM entirely dependent on their internal combustion engine trucks in North America.
Right.
But what happens if regulatory pressures, like federal fuel efficiency mandates and emission standards, accelerate faster than their EV adoption rate?
Oh, that's the nightmare scenario.
If GM is legally forced by regulators to throttle back production on those highly profitable gas-guzzling trucks, before this heavily restructured EV division can actually stand on its own 2 feet and generate a profit, where does the cash come from then?
It is the ultimate existential risk for legacy automakers. You are racing against a regulatory clock while trying to self-fund the very technology that will replace your primary source of income.
Absolutely. If you want to keep tracking how these massive corporate shifts play out on the balance sheet and understand the mechanics behind the headlines, make sure to hit follow for our daily, no-fluff earnings deep dives.